welcome to a special edition of Hospitality Tech Influencers and Innovators. Michael Frenkel's right there. I'm Glenn Haussman. We're here today to talk about the SVB Bank meltdown and all of the other ramifications of that. Michael, what's going on out there, and who do we got?
Oh, you're asking me. Well,
hey, listen, I don't know. I'm just a podcaster. I don't know anything.
Sitting in my office with CNBC on in the background there, watching it. Listen, it's busy times. It's crazy times as always. This is a big one. It's been a year, Glenn, if you can believe it, since we did our first Innovators and Influencers podcast.
Yes.
And here we are a year later, heading into chapter 2. But in the meantime, there's a pretty big issue on people's plates right now, right? Which is, as you said, the collapse of SVB and the implications thereof. And we're really excited as we commemorate a year, in addition, to have Lee Pillsbury with us today. Lee was our first guest on the Innovators podcast. He's the chairman of TLG Investment Partners, the founder of Thayer Lodging, the legendary real estate concern, and also managing director of Thayer Ventures, the leading venture capital group in the space. So Lee's got an awful lot to say about what's going on. Let's bring him in. Here.
Lee Pillsbury, so great to see you. Thank you so much for joining us, particularly under these circumstances.
Glenn, Michael, it's great to be with you.
Lee, good to see you. Let's dive right in. We appreciate your being here with us. Tell us your general feeling about what's going on right now, right? We had SVP go down a few days ago, Credit Suisse this morning. Where are we?
Well, if you look back to the 90s savings and loan crisis, that was a volcano, and you could feel it. You could feel the pressure building for some time, and then of course it all blew up in the savings and loan crisis. And in some respects, 2008 financial crisis, again, you could see the pressure building in the market, in the residential market, and all of the things we've talked about over the years. Right. But again, kind of like a volcano. This, to me, is more like an earthquake. It's sudden, it's unexpected. We didn't have any rumbling telling us it was coming, and so in that respect, it is different than what we've seen in the past.
In the earthquake analogy, where are we on that Richter scale with this quaking?
Well, this is either a 5.0 and then it's going to settle down, or this is a tremor before the big quake,
right?
That becomes a 7 or an 8, and right. And the other analogy I would say is like an earthquake. The earth is moving beneath our feet right now. We really don't know from hour to hour, almost minute to minute, where things stand and how stable the ground we're standing on is. And so right. We thought Sunday evening, when the Fed and the Treasury teamed up to underpin the deposits at SVB and the other bank, that would be a stabilizing influence. To some degree, it certainly was. But as we saw early this morning in Europe, Credit Suisse, NBP Paribas, Soc Gen, all have come under a great deal of stress today. So it is very much a fluid situation, and the earth, as I said, is moving under our feet.
So what I don't understand is, what does the SVB bank situation have to do with any of these other banks? I guess is, how are they all interconnected that this cascade effect can possibly happen?
So an awful lot of the deposits at SVB were from their banking clients,
right?
Whom they required to maintain all their banking with them. And a lot of companies had a lot of money there, hundreds of millions of dollars, tens of millions of dollars, a lot more than the consumer would have we as consumers have at other banks. So the risk there was not foreseen either by the groups that put the money there or by the bank itself.
Right.
And clearly that was a mistake. What's happened, the signal to the market, however, focuses on the $250,000 maximum principal guarantee that the Fed has across the banking system.
Right.
So if you, for example, have $1 million in a bank, which sounds like a lot of money, but for retirees, for
Right.
a lot of individuals, for
Yeah.
a lot of companies, is not
That's right.
an unreasonable amount.
Sure.
You're the regional bank, you have some exposure there. Will the Fed stand behind my bank? And there was an interesting study that the finance faculty at Kellogg Northwestern University released today that said there may be as many as 190 regional banks that are vulnerable if you start to see outflows.
Is 190 regional banks a lot of banks? I mean, how many are there?
Yes, it's a hell of a lot of banks.
Okay, all right.
It's a hell of a lot of banks.
Okay, yeah.
It's a hell of a lot of $1 million deposits, right? Yeah.
Right. Yeah. So that's pretty. This is a pretty nerve-wracking kind of a situation. So for you immediately, how are you thinking about how this will affect our world here in the hospitality industry?
So first of all, if I had money in a regional bank, I'd be on the phone immediately to one of the big banks that are quote unquote too big to fail.
I understand, like Citibank and some other ones seem to be getting an inflow of business right now.
The obvious ones are B of A, Wells Fargo, Citi, JP Morgan, that are all classified by the government as too big to fail and highly regulated and closely monitored.
Right.
So if I had deposits in a regional bank, I'd be on the phone the next morning. And in fact, my bank is B of A, and talking with them early Monday morning, they were being inundated with requests to open new accounts.
Right. Yep.
And move to. So clearly, this is where the risk lies for the regional banks, is that if they start to see massive movement of their depositors leaving, putting their money out, that's how this crisis
I
expands.
get it. So those banks themselves might not be financially unsound today, but if people start withdrawing, i.e. a run, there's not enough to cover all of those funds, which puts everyone in peril.
Exactly. A bank takes in $1 million, it can't put it all in its safe. It's gotta put it out. It's gotta buy people's notes, whatever. And typically it retains about 10% of its deposits to meet current cash needs. So if all of a sudden they're hit with 50% of their deposits wanting to withdraw, right, they're going to become insolvent.
And so, Lee, as in so many things, the state of the play is with the Fed right now, right? That's what we're waiting for. We're waiting for the Fed to step up and say we're gonna stand behind these banks.
I don't believe the government can stand behind the entire regional banking system.
So what would that mean then?
So it means if we do get a run, that we're likely to see depositors suffer losses.
Right. Yeah. And that would not be good for the entire economy.
Right.
All right.
That would trigger a massive recession.
That was going to be my next question. And we promised you in advance, no, we're not going to ask for predictions. We're not going to ask for prognostications. But how likely do you think this is to remain localized, if you will, to the banking system, as opposed to spilling over into a major economic event?
Well, let me get to the bottom line.
Yep.
This is transitory. I don't believe this is a systemic shift in our banking systems or our economy. That's the first thing. Number two, regional banking is very important to our economy.
Yep.
And it provides an awful lot of the engine for growth and to fuel our economy. And I don't believe that's going to disappear.
Mhm.
And my third comment is that the government has a lot of tools in its toolbox
Right.
to address problems like this. The Fed, the Treasury, the administration, all three arms have a wide variety of things they can do to address problems and crises like this as they arise. So, and based on their collective action Sunday night, it's clear that they are working closely together.
Yep.
And that they are aligned in minimizing the damage.
How do you feel about the reaction that you're seeing right now in the market versus 2008, during when the housing crisis caused the big financial dip?
Well, when somebody yells fire, we all run out of the burning building.
That's right.
And if it's a minor fire and it's quickly put out, we're back inside the building, very quickly.
Mm-hmm.
And I think that's where we are. I think that's the situation we find ourselves in, and I think we're all looking for the exits.
Right. Yeah.
And I think it is very transitory.
Michael?
So, yeah, let me go back to Glenn's question then, Lee. This is obviously a podcast primarily aimed at hotel audiences and the travel space. We saw you quoted this morning in Jeff Weinstein's piece about sort of development and lending. Could you speak a little bit about, what are the current and likely impacts of this for the hotel space, for transactions and for new development in hotels?
Well, certainly in the near to intermediate term, the regional banks are going to be very much risk averse, very much risk off.
Mm-hmm.
They're unlikely to be originating new loans. They're going to be looking to tighten or close credit lines where they can, and they're going to be taking steps to protect their own balance sheet. And as a result, we're going to see financing become more difficult, the underwriting standards being much higher, the coverage ratios being higher, the interest rates, pricing of debt being higher, and the general availability being lower. So whether you're building a hotel, whether you're financing inventory or receivables or working capital, the regional banking system is not going to be supplying the same level of liquidity that it was before.
Right.
Right.
Now, I've heard some speculation from the other side among the financial talking heads that this is going to force the Fed into a situation of having to actually cut rates or at least stop raising rates earlier, right? That would cut in a favorable direction for our audiences if it were to happen.
Well, there's a number of pundits who've been saying for some time that the Fed should pause the rate increases,
Right,
and pause shrinking of its balance sheet. I would just remind everybody that the Fed has two objectives: controlling inflation and maximizing employment.
Right.
The employment numbers remain very, very strong.
Right.
Yep.
Inflation remains well above their target.
Yep.
Right.
So while it might be nice to point out to the Fed that this transitory banking problem is with us and that they ought to do things, that's not one of their objectives.
They got a
Right.
mandate.
Not one of their goals.
Yeah.
So
Right.
if they pause, in my view, it won't be for long.
Right. Yeah. I think all of that makes sense. So overall, are you advising, because you're an investor obviously in a lot of hotel tech companies, are you advising the CEOs and management teams at those companies to just take a deep breath and let's see where this goes, or are you advising something else?
Well, what we're saying is one, review your exposure,
Right.
throughout your balance sheet, and take steps to minimize it. if you've got an open credit line, draw down the cash.
Mm,
If you've got receivables, if you've got aging receivables, get on it and fix it.
right.
If you're, talk to your suppliers about negotiating extended payment terms. Take all of the obvious steps to strengthen your own balance sheet. Where you have term debt that's maturing, get out in front of it and negotiate extensions, even if you have to pay a premium to do that,
Mm-hmm.
so that you're sure that you're not going to have a liquidity crunch.
Right.
So, and finally, keep in close personal touch with your counterparties.
Right.
Mm-hmm.
Got to. Lee, let us, ask you, another area that you're very active in is obviously hotel tech. And this is a show about technology and innovation, and it's Silicon Valley Bank. A lot of startups feeling pressure right now, not per se in hotel or travel technology, but across the technology space. What's your point of view there? I mean, we've made great progress as an industry, or some progress at least since the pandemic, in sort of hastening technology and technology adoption by hotels. Is there a chilling effect here? Are startups in trouble, or where are things going?
On the contrary, I think Silicon Valley Bank had a near monopoly on this business.
Mm-hmm.
They failed not because their customers were in trouble. That's not what happened.
Right.
Their customers, the tech companies that they do business with, are not in trouble.
Mm-hmm.
They're not unhealthy.
Mm-hmm.
So when Silicon Valley Bank is taken out of the picture, it leaves the door open for competitors to step in and fill this void.
Mm-hmm.
And it's a very attractive void. Silicon Valley Bank grew to be the 16th largest bank in the country and to be very profitable.
Right.
So I expect to see a lot of increased competition lending into the tech markets now.
That's fascinating.
Love it. Love it.
Yeah. And I think it shows a larger lesson when everything goes in one direction, the innovators and the influencers are going in the other and setting the tone for the next era of hospitality. Anything you want to leave us with, Mr. Pillsbury?
No, the old Chinese proverb, "May you live in interesting times."
Yeah.
And this is certainly a fascinating time. It is transitory, and I remain cautiously optimistic, very optimistic for the long term.
Excellent. Michael,
Words
anything else?
Words of wisdom. Thank you, Lee. Appreciate it as always. We will. We're sorry to interrupt your break and your vacation, cruising around down there, and we will have you back again for a more extended time where we can talk about happier, more stable topics.
Great.
Michael, thank you. Glenn, nice to see you all again.
Yes.
Thank you.
Take care.
Thanks.
Bye-bye.
Take care.
That was really wonderful. I'm glad that he could take time out of his busy schedule, relaxing to come talk to us. It's even more impressive than if he's had meetings all day long and popped out to talk to us. Michael, you want to wrap this all up in a nice bow for us and we'll get out of here?
Listen, I mean, Glenn, this is a guy who's been there and done it now for decades, right? And he, as he said at the outset, he saw the savings and loan, he came through it stronger. He, founded Thayer Lodging coming out of savings and loan, which went on to 23 years of incredible returns. Came through 2008. I think his words are to be heeded, right? It's an earthquake, but it's a transitory earthquake. Let's buckle down, push for the future, and get on to bigger and better things.
Yeah, I love it. And on that note, I want to thank everybody for watching this special edition of Hotel Tech, Innovators and Influencers. We hope to see you again real soon. Have a great day.
Thanks, Glenn.
See you later.